Good morning, everybody. This is Retirement Income Options and Stocks for the Week. I'm Kirk Spano, and we're going to cover a lot of stuff today. I wrote an article this weekend covering technical analysis. Everybody had asked kind of how I do it. I had a couple of old articles that are a bit out of date, so I updated it and spent the better part of 2 days writing it. So I hope that you have gotten a chance to take a look at that. It's on margin of safety investing as well as fundamental trends in both places in the resources and getting started areas. I think that learning some basic technical analysis will be very useful to you, even if you're not a trader. There's a misnomer that you have to be some sort of short-term trader to use technical analysis. That's not true. And I will show you several charts today that make it very, very clear. But first, let's start with, change my mind. Let's take a look at that now. I'm going to show you the examples that I put in here. Covered a lot of different things. My settings for my charts. We'll give you the first example. And this is QQQ using monthly settings. When I say monthly settings, that means that the measurement periods are the end of the month. So at the end of January, February, March, April, that's the measurement period. Measurement periods can be minutes, even seconds, hours, 4-hour periods, 2-hour periods. You pick the period that you want to measure. So this is a long-term chart. It shows market tops and bottoms pretty well. When you take a look at the indicators that I use, relative strength index, money flow index, shaken money flow, MACD, I use the Elliott wave oscillator just to alert me to when I should look at an Elliott wave chart. And it really, Elliott wave oscillator is partially MACD. And you'll notice that the two charts look quite a bit alike. I don't really know that you need the Elliott wave oscillator, but it's just a way for me to see if there's any divergences here that would alert me to look closer. Now on this chart, I would say look for a divergence. What divergence do you see right off the bat? You have relative strength index going up. You have money flow index going up. And this is during a down market in stocks, right? It bottomed here, but it still went up, double bottomed on the price index, then it went up. So we see that at the end of 2021 into 2022, the strength of the market, the underlying money flows got weaker, and then they started to rise a little bit. And we're seeing a rally at the start of the year here. The shaken money flow here, still pretty low. This is usually an indicator that big money is not taking part. That should be scary to you. So let's move to a shorter time frame down to the weekly chart, which would be a measurement not so much of super long periods, but more intermediate time frames that will help you in the 2, 3, 4, even 5-year period. That monthly chart, like I said, that's the long-term view, 5 to 10 years or longer, depending on where we are in a market cycle. Of course, bull markets usually last 3 to 7 years, and bear markets generally last a year or two. The longest one's 3 years, the shortest one 9 months so far, and that was the financial crisis. Depending on where you measure from, actually, the financial crisis, if you measure from the peak at the very end of 2007, that bear market actually lasted a little over a year and a quarter, so 5 quarters, I believe it would have been, versus the 9 months that most people associate with it from when it first fell off that cliff when everybody on TV was holding their breath when Lehman Brothers went down. But of course, I was writing articles that started 2007 and 8 telling you that, hey, there's something wrong with the system. Here are the signs, could be really bad. And we had largely gotten out of the market before the crash came. How did I know to do those things? It's these charts that tell you sort of where money flow is going. And why is that important? If there's more money chasing assets, the price of the assets will go up. It's very simple supply and demand. If the amount of assets in the world is roughly similar month to month and year to year, just drifting up a little bit, but there's more money trying to buy those assets, pushes price up. So why did we see a big correction in 2022? Federal Reserve stopped putting money into the system, raised interest rates, which, as I showed in last week's Macro Dashes article, tightened the financial conditions. And this year, they're scheduled to take $1 trillion, actually over $1 trillion out of the system. So if 200 billion caused a big correction, what would taking $1 trillion out do? So there's only a couple of scenarios that can play out. So we'll talk about that in a minute. In any case, back to the technicals. You can see down here that on the weekly chart, Shaken really started to rebound from autumn and went to a positive sign. Now, you can make these charts bigger and zero in on one indicator, but right now, money flows are almost overbought. If you look at the relative strength index, the money flow, and Shaken isn't super strong. Compare it to here, compare it over here, compare it here, here, and it looks like it's almost turning over, meaning that we should worry about big money taking profits on this rally. And if that happens, that'll change the technical trend. What does the really short-term time frame say? What does a daily time frame say? So if you're a swing trader, this is very important to you. Here and here, you can see, and again, look at the article. You can see that it's becoming difficult in the shortest time frame that I use, the daily, for the market to become overbought. It's because nobody wants to get caught with their hands in the cookie jar. So could this spike up? Certainly it can. We can still see prices jump up quite a bit. This chart's from Friday, so it's not like it's outdated. We could clearly see a rally here up to about this purple line. Above the purple line would indicate a change of direction for the trend to make that happy face that I talked about. But I doubt that it'll get there, because this is indicating that unless there's some influx of money that we don't have right now, it'd be tough for that to sustain. Shaken money flow is turning just a little bit up. That could indicate that the very first big money buyers are getting into the market. No, the big money buyers could be the mutual funds. That's not very smart money. Mutual funds have chronically been disappointing, but they do give us an indicator. I like to watch the family offices, and they have not, according to Institutional Investor Magazine and some of the other sources I follow, family offices and some of the big hedge funds have not turned bullish on this market. What they have talked about are alternative investments and small cap technology, which is where I've been pushing you for a year and really pushed hard at the end of last year. So if you had expanded your small cap holdings and your emerging markets holdings, which is essentially what I was pounding in the fourth quarter, your portfolio today is up 2 full percentage points, probably up 8, 9, 10% for the year. And I say that because that's what mine is up, and I'm still over 20% in cash. So the question you should ask yourself is, well, how do you beat the market and still hold more cash? And the answer is pretty easy: hold the right assets. And if the dollar comes down and the Fed backs off at some point later this year, whether you participate in the little gyrations month to month, by the end, if you have the right assets for the right financial conditions, you're going to do well. And these technical charts, this is QQQ, give you a hint. Now, I will tell you something that's going on with QQQ. You have big layoffs at Facebook and Google and Amazon. I'm not really sure if Apple's laying people off. They probably are. But big tech is laying people off. What should you infer from that? It's a legit question. Put that in the chat. What should you infer from big tech laying a lot of people off? No guesses? Somebody says a slowdown is inevitable. Growth is slowing. Somebody says they'll access their 401ks. Well, I look at it a little bit differently, as you probably guess. I look at the big technology companies laying people off as an indicator of what I told you 3 years ago was going to happen. I told you that artificial intelligence, right? Go second and third derivative of this stuff. Don't listen to the pundits and the stupid shit that's on the internet, all the narrative tellers, creators, fakers. I've seen so much garbage information in my career that I'm pretty immune to it now, but I can tell you that these narratives are crap. What did we talk about 3 years ago? And I know there's quite a few of you who are still here about artificial intelligence. Who is at risk? Who's at risk? It's all your MBAs. I put it somewhere. There's a quote from somebody at a major university who said, if ChatGPT, meaning basically artificial intelligence, can do all these things, then what is an MBA worth? Well, an MBA still has a ton of value, especially when it's attached to another skill, right? You're an engineer, you're a doctor, right? You're some sort of skilled person. But when you get an MBA for the simple purpose of managing, right? I want to be the boss, but the AI can do 90% of the organization and scheduling and everything else. What do they need you for? If you're not actually good at leading people, right? If you're one of those middle managers, who just yells at somebody once in a while when something doesn't go right, who looks over their shoulder without being constructive, who doesn't really have the technical skills of the team that you lead, what good are you? If the AI can keep tabs on things and do the scheduling, do the logistics and everything else, manage the money for a fraction of the cost of somebody who thinks because they got an MBA, they should make $300,000, $500,000, $600,000 a year. If you took a look at the layoffs at Google in the last week, they fired a lot of middle management that was making six figures. All right, so that's the first step that I think about. I think, how do the tech companies lay off all these people when that's really where the only growth in the world is, aside from emerging markets and clean energy? We'll talk about that in a second. How well are these big tech companies going to do in a few quarters when all the severances are paid and all the work that was getting done still is getting done, and they've eliminated billions in salaries? Somebody says better earnings. That's exactly right. So the big tech companies that everybody says are crap, that have been rallying this month, are going to do very well at some point. So the reason I don't invest in SPY is because it includes all the shit companies. QQQ, almost everything is tied to the consumer and to technology. Some fintech, some biotech, things like that. All good stuff. All companies either provide technology or benefit from it. So if this goes up and it breaks about this spot, right? If it gets back into the 300s, then maybe we've bottomed out. Maybe. My guess is we don't break out from here, that it comes back down here. And I take that from the weakness, not that it hasn't rallied, but it's having a hard time continuing. So your breakout usually means multiple breakouts. Goes up, comes down, goes up, comes down, goes up. That's the whole point behind Elliott wave theory, the patterns that they focus on. And those patterns are there because people act the same way all the time. There's only minor changes from time to time. There has been a major shift in the last 3 years. What is the major shift in markets the last 3 years? Give you a hint. Who is the major shift in markets the last 3 years? Starts with M, ends with millennials, right? The millennials now are controlling more and more money because they are the ones earning, whereas the boomers keep filtering into retirement and will almost all be retired this decade. Meanwhile, the millennials get into their peak earning years and they're starting to inherit money from grandma. Then after that, they're going to inherit money from mom and dad if they haven't spent it taking care of themselves. But the millennials and the Gen Zers, hop jobs, they look for top dollar. The millennials, because they came into their employment in the early 2000s, for the most part, had to face a financial crisis right off the bat, right? Most millennials, and we talked about this 6, 7, 8 years ago, started behind. And now they're pretty much all caught up. And in fact, the millennials have saved more towards retirement than the boomers did at similar ages. They threw a bunch of it at crap crypto, told you that most crypto was going to zero, and there'd just be a few survivors, and those survivors would be worthwhile. We're almost down to the survivor phase. What is it? Something like 80% of all crypto value is now in Bitcoin and Ethereum. And there's about 7 or 8 currencies that take it up to 99%. And then all the thousands of other crypto crap coins are worth under 1%, and that'll go to zero. We're getting the fallout from the original crypto crashes last spring. FTX, I forget what the other one's called. Barry Silber's company just went bankrupt too. Grayscale's going to get sold. There's no doubt Grayscale's going to get sold. It has to. There's no bankruptcy judge in the world that won't force them to sell Grayscale because it's really their most valuable asset. They're not just going to wipe out the debts and say, but keep Grayscale. They're going to say, you got to sell Grayscale to pay some of these debts. Then you can start over with a kernel. Who buys Grayscale? It's already been suitors, so we'll see. There's this little company that's been working closely with Coinbase called BlackRock. Heard of them? And then you've got some big private equity firms, KKR, Blackstone. I'm not saying it'll for sure be one of those firms, but it'll be somebody like them that buys Grayscale. And then what happens? Now all of a sudden you'll have a huge company behind Grayscale, a cash-rich real company, not a speculative, let's see if this works company. About, a month, 2 months ago, I wrote that article on Grayscale and Bitcoin right before Bitcoin and Grayscale started to rally. I'm not going to tell you what to do because I don't know each of you. But if I talk about something today, you should really think hard about it. Not think, well, I'm just wait for the trade alert. I'll tell you when I buy it, but that doesn't mean anything to you really, other than if the things that I'm talking about make sense for you in general, that fit your risk parameters, fit into your financial life, then maybe my trade alerts make sense. For the most part, my trade alerts are generic, just trying to say, hey, here's where I think a bottom tick is, or I actually did it in managed accounts. And most times I have. But I know there's more and more people coming into the services. They want to know, what do I buy today? You have a lot of unlearning to do. And I'm saying this because I know that there's new people here today, and I know there's new people on YouTube. You need to wash your brain, not brainwash, not unwash, just wash your brain, right? That's kind of where the whole unwashed idea comes from, right? Wash your brain. Wash off all the shit that you think you know from the shitheads on television and the shitheads on Reddit and the other shitheads that the hedge funds and other various cheaters in the financial industry feed to influencers now and whoever else to get inside your head to get you to do the wrong things. This whole idea of what do I buy today is a shithead idea. So get it out of your head. Start thinking about what are these big trends in play? What did we learn from Davos last week? What is the big theme that was covered at Davos? Did anybody read the Bloomberg articles or Wall Street Journal? The Europeans are pissed and confused, a little bit angry, feel left behind from what? What did Joe Biden and the Democrat Congress do last year? The number one topic at Davos, yes, was the Inflation Reduction Act. It's the biggest bill ever supporting clean energy, and by extension, that supports fourth industrial revolution technology, because the way that you get to clean energy is through fourth industrial revolution technology. What theme have I been pounding on for 3 years now? At some point, there's going to be another giant bull market. It'll start soon, measured in quarters, maybe a year or two, but I think the shorter end of that. And it's not going to help everybody. It's going to help the companies that have the secular trends behind them, government behind them, monetary conditions that loosen instead of tighten, and good fundamentals primarily led by growth, because that's the only way that you refresh the economic system is new growth. Is the new growth going to come from Procter & Gamble, right? I think we've already had the ass wipe wars. Is the new growth going to come from Exxon? Is the new growth going to come from pick your old man stock on the S&P 500 that's heavy in debt, requires a lot of capex, and has no growth? There's between 120 and 200 of them, depending on how tight things get for them on the growth side and how much it costs them to refinance their debt over the next several years. Let's just say that there's 120 stocks on the S&P 500 because that's the lower number. They're shit stocks. What does that do to that index? What does that do to the old man investors when those dividend cuts start coming in again, like they did in 2020, right? What happens when the old men, right? All the old man characteristics, 4 out of 5 old men get emotional when it comes to if they feel like they're failing, if they're not supporting the family, if they're doing something wrong. My challenge over the next 20 years is to not become an old man and to always keep looking at the fact that the world keeps growing. Our standards of living have gotten better generation over generation for since the Dark Ages. I mean, historically speaking, the Dark Ages were the inflection point, and it's a curve that just keeps bending up. If artificial intelligence is going to do a lot for us and it decides not to eat us, what are our standards of living going to look like in 10 years? We were watching on CES a couple of weeks ago. Remember the presentation from John Deere? Remember what those machines that they're building right now are going to do? It's going to cut the price of food by anywhere from 10 to 50%, probably in the middle there somewhere. Why? How are they going to do that? So as now, rather than tilling and spreading seeds and fertilizer over wider areas, it's all going to be targeted. The machine's going to go there basically with the ability to put a pinprick in the ground with a seed, fertilize around that seed specifically, rather than the whole pile of dirt. And they don't have to till, which is a big deal for carbon emissions. So if the price of food starts coming down in the next few years as the technology there transitions, and the price of energy starts coming down in the next few years because of A, panic pumping, and B, the proliferation of renewables, who wins, who loses? Standard of living clearly goes up because we have cheaper food and cheaper energy. The companies that benefit from that do well. The companies who are stuck in the old paradigm of more and more resources being necessary lose, maybe not initially, but eventually. They just shrink and shrink, and they enter what's called the runoff phase. Exxon, independent of its other businesses, just the oil drilling, would be what's in what's called the runoff phase. It means that the company is viable, but it's never going to grow again. But because prices are still supportive, it can still throw off cash. And that changes eventually. So either Exxon has to go through a huge pivot, which is what Engine Company 1 has said since it got that big presence on the board by kicking off a bunch of old men, right? They won the proxy war, right? So stop thinking about, what should I buy today? What should I buy today? Because these charts tell you when to buy, give or take. And if you're in the right sectors and industries and companies and countries, you're going to do pretty well, right? Between 50 and 90% of your performance is going to be from asset allocation, not specific stock picking or timing. But that still means between 10 and 50% will be. So we first look to the asset allocation. I don't know that I compound fourth industrial revolution and clean energy anymore, and the industries that benefit from that stuff versus the ones that don't. I've thrown it into two baskets. I first was interviewed about this in, I think, 2017. I said, look, eventually the old man stocks are in big trouble because the technology is changing that fast. And that was when AI was still really young. It was still in a Terminator movie. And then in 2020, right before the pandemic, I started talking to you about what was at CES and saying, look, we have to think about things in terms of 2 years and 10 years. The things that are getting super hyped better be coming in 2 years. If they're not, then there's going to be that crash before the eventual rebound, right? The Gartner hype cycle looks kind of like something right? Had the COVID crash, massive rally on hopium and cheap money. Now we're getting the correction on tighter money. And it's the tech and the fourth industrial revolution technology like space stocks and, all sorts of fintech and biotech that got crushed, even though that's where the growth is. And people think, well, but toilet paper. Okay, capital intensive toilet paper. That's where you're going to win. It's not where you're going to win. The people who haven't sold their old man stocks before the S&P 500 comes down its last leg, and it might go up first. Eventually it has to come down because there's not going to be enough money to support easy stock market gains. How do I know this? Now, I don't agree with everything they talk about here. I don't like the Austrian economist mindset because it's wrong. It's always been wrong. It'll always be wrong. People love it because it's easy to rationalize and fear sells. It's easy to create fear from the Austrian economist boom bust market cycles concepts. The ideas that say that budgets have to be balanced long term. Now, I don't believe in modern monetary theory because it has a couple of things major wrong with it. But even in this piece, they talk about how the Federal Reserve eventually has to decrease their balance sheet. And I would ask why. Are we so stupid that we haven't watched Japan to realize that you don't ever have to reduce your Federal Reserve or Bank of Japan balance sheet? Understand what that is. When the Federal Reserve expands its balance sheet, it's just borrowing from its own, it's working with its own treasury. They have to work on restricting that money because when you do quantitative easing, you generally pump money back into the economy through the banking system, primary dealers, and then the big commercial banks. And you have to find a way of doing quantitative easing without that happening. It's doable. There is a way, and they're going to start doing it. A couple of restrictions on how the money gets used, where it goes. And if there's going to be restrictions on where the money goes, where do you think it's going to go? So right here, they talk about what the U.S. Treasury market looks like. So on last week's Macro Dashes, I talked about that. 4 days after I talk about it, look at that. It's here in a very popular publication. At some point, long-dated U.S. Treasuries will have only one marginal buyer, the Fed. They get the second part wrong. Their idea is that the long end of the curve has to go up. We just saw that isn't true. The inverted yield curve is more from the short end going up than the long end coming down. The long end of the yield curve, U.S. Treasuries, 10 and 20 years, they haven't changed very much. Why? What do they know is forever? What does the bond market know is forever? What's the term that I've been using for a decade now? What is forever? Say it. I'm going to go Sam Kinison on you. That's right. Slow growth is forever. And if slow growth is forever, because population growth is going up slower, and because we can't keep growing unconstrained just because there's not enough land at some point, slow growth is forever. Who wins and who loses? The growing companies or the not growing companies? Pretty easy. So it's not that the long end of the curve has to go up much. It's that the short end of the curve will come down again. And when they do QE next, when they do quantitative easing next, I'd say New Year-ish, late this year or sometime next year, when they do QE again, they're going to channel it a little differently than they did the last times when it was just everybody gets money. And it's going to get directed towards the companies and the industries and the places that they want it to go to. Now, your Ken Griffins of the world and your Exxon executives of the world can bitch and moan about it all they want. It's not going to matter. Demographics are destiny, and destiny in the United States is that we're going to become a little less right-wing. It'll be enough to keep tipping these elections like we just saw. It's very easy to look at the demographics and realize that states like Georgia and Arizona, Texas, drifting purple is no coincidence. It's just the demographics. It's what people believe. It's very hard to keep brainwashing people to the right when the brainwashing to the left is stronger. Just the way it is. I'm a centrist. You all know that. I mean, I'm a hawk when it comes to certain military stuff. I look at this very simply in the data. The data tends to support me. I'm in line with a lot of it. I don't buy into all the kumbaya. I think we should kill the bad guys. I don't have a problem with that. But I don't think that we should rape and pillage. I don't think that we should pillage places like we did during the 1970s and 80s and 90s when Chevron and Exxon were going around the world wiping out water supply so they could get oil. That happened. And a lot of that had to do with people who believe in business cycles as God and economic theories used to justify certain behaviors or a way of rationalizing what they think should be, even though that none of the evidence supports it. So if you've ever bought into the idea that John Maynard Keynes had it mostly wrong, or that there's something fundamentally wrong with what he said, you really should read the book, even in a abridged version, or listen to it on Audible, because it's important. In the end, we're all dead. That was one of the things that Keynes said. In the end, we're all dead. And that puts a huge, huge red underline on the way that the banking system and the financial system and the monetary system can work. Why? What did Japan show us? Japan showed us that you can finance an aging demographic by just borrowing the money from yourself. Take the money from the right pocket, put it in the left pocket, and when things get too loose, you put it back. When things tighten up again, you move it over again. And that means that the Federal Reserve balance sheet is destined to grow because we have to get through a couple of decades of big-time demographic-driven expenses. And what they're going to try to do over the next 20, 30 years is balance everything out, because 20, 30 years from now, the millennials retire, and there's not going to be enough people behind them. So we have to figure out a way of not only paying for the baby boomers, but preparing for the millennial retirement. How can you do that? Look at this chart. Government trust funds, which are imaginary. Federal Reserve, state and local governments, which are in pretty good shape at the moment. They should be saving their money for a rainy day. They won't. They'll give tax cuts and rebates and everything else because they're dumb. Pension funds are going to go away because nobody has a pension anymore. Those are in run out. And then foreign buyers of U.S. Treasuries probably going to level out because the emerging markets are going to start buying. The dollar will remain the strongest currency on the planet, but it'll be restrained. It's in that new higher range that I've talked about. It's going to go down a little bit now in the next year or two, 3, whatever. But it's not going to go down to where it was. And who's going to soak up bond issuance when there needs to be somebody to soak it up? It's going to be the Federal Reserve. And you're going to keep hearing these Austrian economists say, well, that's just a recipe for comeuppance, a future catastrophe. There's been people talking about the collapse of the dollar since I got into this business, 3 decades now. They've been wrong. They've sold a lot of books. Rickards has sold a lot of books. It's been wrong the whole goddamn time. It's been wrong the whole damn time. But they sell subscriptions because it plays into our psychology, which is to be scared, to be able to look at the world getting better around us and think it sucks. Would it really bother you if your standard of living went up, but you only had to work 30 hours a week instead of 40? Would that really, really, stick a craw on you? That's what's coming, folks. And I've said this before. I've told you the story about how I wrote a paper in college for economics. I got a C. Anytime I got a C, I knew that I was above the professor's head. I learned that later because I got C's in writing classes. Teachers who said, I don't know if this is amazing or crap, because they couldn't look forward. They could only look back. Why? Because professors are taught to look back. The really good ones look forward, and there's not many of them. 1 out of 5, right? Always go back to your 4 out of 5 principles because they're pretty close. Right now, in the markets, we're getting greed. Will we get extreme greed? If we do, you want to sell it. So we might get a little bit more rally before the snapback. It'll be tied to Fed policy. It'll be tied to earnings. It'll be tied to international events. You can't predict all those things, and neither can I. So we use our indicators to get us close in the things that make sense to own long-term. And if this market gets down to here and you've invested in a little bigger circle, remember one of our economics lessons, if your chart doesn't look quite right, make your lines and your points a little bit thicker. I had a really good professor tell me that. This line right here, man, I tell you, doesn't that make just a ton of sense that we see QQQ bottom out maybe the 240s? Now, if you believe all this Austrian crap, then that means that we're going to go lower and possibly get into the Armageddon zombie apocalypse zone. I find that hard to believe. Doesn't mean it can't happen, because I can't believe it doesn't mean it can't happen. But at some point, we definitively know, no question about it. We absolutely, positively know, regardless of which way you look at it, Austrian or Keynesian, the Fed's going to have to buy bonds. That money's going to get into the banking system, and the primary dealers are going to light it up. And the companies that do best are the same companies that are getting their asses kicked right now, or actually up until a couple of weeks ago, right? All those people telling you how technology was just overvalued and in a bubble. Take a look at the PEG ratios, the price to earnings to growth ratios. They've all come down to either fairly valued or undervalued. There's like no tech in the country that's overvalued right now. It's either fairly valued or undervalued. And the things that we're in are grotesquely undervalued if you're really thinking 3 to 5 years out, which is what I keep suggesting. And you might have had to extend that a little bit because COVID was one of these things that changed things, right? COVID was kind of a one-off thing. And I've said that for a long time, right? I've told you that COVID helped us pull forward a lot of the bailouts of the future. Look what Chair Brainerd just said. There are reasons to think high inflation and more labor-intensive core services, ex-housing, might reflect pandemic and war one-offs, right? COVID and Ukraine, Russia invading the Ukraine, are one-offs that skewed things, didn't change the fate of history. I'm going to give you a shortcut. You don't even have to think about it anymore. This is just the answer. Here's the answer. The answer is the world will keep getting better. It'll be led by technology and clean energy, and everybody who benefits from cheaper energy and cheaper food will do well. Everybody who's tied to the old paradigm of trying to get 14% per widget, or whatever their margins were, are going to see their margins tighten. Because in a few years, what are we going to be talking about again? Is inflation or deflation going to be the big theme in a few years? Deflation. Absolutely. It was the theme for 40 years. And technology is going to make food and energy cheaper, which were the number 1 and number 2 drivers of inflation. So if you want to hedge, pick the right hedges. What are the right hedges? Oil? Nope. Oil's going to get cheap. It's going to get really cheap 4, 5, 6 years out. Now there's one more uptrade in it. And then you have to be in the right companies for the runouts. In oil, what are the runouts? Are they the diversified companies? Are they the companies with a lot of debt? Are they the companies that can take part in carbon capture? Which companies are they? And you have to look at them on a company-to-company basis. Somebody asked me today, have I done all the analysis that I put into a Metis into my other stocks? If it's on the plug and play, I have done a similar Metis-style breakdown. I don't publish them all because they get stolen. When do I publish those? Right? I give them to you bits and pieces at a time. That's why you got to follow along. When do I publish the great big breakdown? Hopefully after you've all bought and I've bought all I want, and then I take it out to the public for almost free. I've been getting my ideas stolen for 20 years, man. A little longer, actually, since 2002, when the other brokers started to realize, how did Spano know this 2 years ahead of time? And it's because I look at things through a Keynesian viewpoint, if you want the shortcut. You know that John Maynard Keynes was a spectacular investor? Spectacular. He understood. So while you can sell a lot of subscriptions and drum up a lot of fear and get a lot of people to harumph being an Austrian, you won't be right. You'll just get to repeat yourself and make money if you're selling the subscription, not necessarily if you're doing the investing. Now, weirdly, Grumman here and me agree on something, and that's how to invest the money between now and the future. I'm going to talk about gold and Bitcoin, not today, but I would encourage you to go back and read my article on the gold bull market. For those of you who have been with me long enough, remember what I said. At some point, gold is the better investment than gold stocks. On the front end, the gold stocks, because they were super undervalued, but levered to a rebound in gold and benefited from monetary policy, right? Cheap money to dig up more gold would do well. That only lasted about a year. We are clearly in the age now, and we talked about it. I want to say it must have been autumn of 2021, right before we talked about how Fed policy was going to work. Because physical gold is the better investment now than gold stocks. I probably will never own gold stock again unless I find a micro cap that has a whole bunch of gold underground and somebody's going to come take them over. Like, what was it? Millennium Lithium? Is that who got bought out up in Canada? I brought it to you guys a couple of years ago and it got bought out like 3 months later. There are micro caps out there and small caps out there that might be worth investing in. But for the most part, big mining operations are going to have a problem because it's getting more expensive to get the minerals out of the ground, especially gold and silver. Therefore, the better investment based on scarcity is the gold and silver. And the other place to watch is Bitcoin, because as the world fights the dollar getting stronger, and as we go through our back and forth with QE and QT, Bitcoin becomes the hedge that emerging markets can use to keep growing, because they really get their asses kicked when the dollar gets strong. So they need a way of preventing that. And you'll see how our booms and busts have come more frequently, but have been less severe, with the exception of the financial crisis. So slowly, everybody's learning the formula. Thank you, Japan. We basically operate within two different monetary systems, global and domestic. And we can pay for getting old. And technology will make it not as painful, and in fact, make it better. All right. Spent a long time on that, way longer than I wanted to. I'll edit it down. The retirement income options will get a couple updated trades. If we get into this area, we're going to want to write covered calls. If we get down into here again, sell a lot more puts. Keep an eye on your individual positions based on plug and play. Now, I'd point out one particular stock. If you go to this one, so when this stock was up here, and I put a bottom fishing price of 78 on it. Teresa, I know you've seen this before. Kind of funny that Seeking Alpha uses TradingView. It's a pretty good system. You should probably sign up. Got all the links right here. All the links are in here. If you want to sign up for TradingView, at least get a free account. When this was up here, I told everybody it's going to come down. Some people bought it here. You've seen my chart. My bottom fishing price on this for over a year has been $78. And I get every time, when I said ARK was going to come down 60, 70%, ridiculed. I said this was going to drop. Oh no, ridiculed. Here we are. We are almost to the buy zone, the area that you should be buying this stock because of what the company is. Do they have some problems? Absolutely. Did they get overvalued? Absolutely. And now we're in the capitulation phase. At some point, the last FOMO people finally bail out. They blame the world for their shortcomings on investing, and the big money starts to scoop this up. Why? What is so good about innovative industrial properties? Well, number one is they have a backup business. It's pretty important. If they ever have to grow food in their greenhouses, they can. Be a pretty easy transition. But more importantly, their primary business, which is marijuana, is eventually going to get more government support. Step two, secular trends, government support. And if you watch what's going on with alcohol versus marijuana, it is clear people are choosing the lower calorie vice. Right? Blame it on low cal. Blame it on managing your carbs. But eventually, the Congress has to support financial reform in the marijuana industry. It was proposed, it didn't get passed. It will eventually. So if the marijuana growers just become legal on a federal level, that's probably second. But that the banking is allowed, right? That these companies can bank. That's a positive surprise. It's coming. It's no longer priced in like it was over here. People are just throwing in the towel right now. Does it go down to 78? Yeah, give or take. I mean, it might get down into the 60s. I don't see it. Man, if it got below 60, I'd be a little surprised, but it could. But now we're splitting hairs. Told you up here, going to drop way under 100. No, never happened, Kirk. You're out of your mind. And here we are at 88. A year later. This chart, look, right? How many charts can you find that look like this? Boom. The last ones to fall will be the old man stocks. The old men hang on to the end, then they throw in the towel. And they give up, and they get negative, and they blame the world. So what happens? Not all old men, just 4 out of 5. But it's enough your Procter and Gamble's of the world. Have you noticed that I'm not very supportive of Procter and Gamble going forward, right? I know some people still own this. Procter and Gamble will be under 100. How's that? Next couple of years, Procter and Gamble will be under 100. It's overvalued. It's got no growth. Eventually, the profitability starts to go away. It's just the way it is. If you don't have growth, your profitability goes away. That is a universal rule. And in a world where financing will be a little bit more expensive than it was, because I don't think we're going to see zero rates again, companies like this will survive on the base business and the occasional bailouts. They're not going to be great investments, though. Eventually, these dividends essentially get frozen or they fall. I mean, maybe they raise it a penny a year. You've seen all the companies that do that. Oh, we've raised our dividends 75 years in a row, but it's been a penny for like the last decade. Any company that's raising their dividend by a penny a year, you should be scared. It's a warning sign. All right. I'm going to put these into an article for margin of safety, but I have shooters charts, and I just want to show you why the technical analysis, which is our fourth step, why I went through the first, second, and third steps again, right? Secular trends, government, central bank policy, fundamentals. Take a look at these charts. Up here, you're nuts, Kirk, if you think it's going to drop down to 100. And here it is. Cisco. I've been very lukewarm on this one, right? Because they don't have much growth. It's just chopping along. I took it off the list, right? On this last plug and play. Just going to chop along. It'll pay out its dividend. There's no going to zero risk. But it's just one of these old man stocks. Shopify, right? Big growth, crash. Another one of the charts that look just like this. So now you got the prices where you need them. You have to start asking yourself, is this a great company over the next 3, 4, 5 years? Learn what they do, because they're going to be. You're going to get your hype cycle play out just like the Gartner chart. Steg Industrial, big reflation trade company, right? Spiked up on the cheap money, more expensive money brought it down, probably gets another dip down here in this range, and we're going to want to buy it. Uber, a lot of moving parts with Uber, but ultimately, they have a business model that's viable. It's going to take some adjustments, some negotiations with government, and then they're probably going to have to become more of a licensing company than an operating company. What do I mean by that? Rather than being Uber drivers, you'll be working for a different entity. There's going to be a middleman company, either the taxi companies or somebody, because these guys are getting tired of dealing with the government. They're just a tech company with something that works, and they have to figure out the middle ground, right? It's another one, another Gartner cycles chart. There you go. Here's Freeport-McMoRan. This one's getting the spike up on because everybody's like, well, we need 20% more copper year over year. We do. 4 giant copper mines just open. At some point, we're going to get a dip in Freeport-McMoRan. Shooters saying down into the 20s. We'll see. We'll figure it out then. But all of these companies with high capex, you can only really buy them on the crashes. I don't think this is the crash. I think we get that 20-something price. But even if we don't, there's a limit on how high it can go. So even if it double tops, which it very well could, right? That's about where its target is, then it comes back. This is the definition of the middle of the market. It's a hard trade. Skip it. Ford, get the spike on the hopium that the future is 2 years away instead of the reality that on EVs it's closer to 10. Getting your reset. Now the slope of adoption. I will tell you something. Ford is going to beat Tesla. I think Ford is going to be a top 3 automaker in the world for a very long time. Right now, it's not quite at 3. It's going to jump all the way up to 3. And I don't think anybody catches Volkswagen, but, we'll see. But Ford, with their various technology and real estate that's opening up, is another one. I think this is my top dividend paying stock. I'm pretty sure it is. If it's not, it's real close. Vici, I'll tell you something. As an inveterate gambler, not really. I just like poker. The occasional craps game because it's entertaining and not a lot of thinking involved. Starting to rethink the whole gambling thing. I saw that Caesars redid some bonds or is trying to redo some bonds. I don't think that these are the easiest plays anymore. I think that online growth has a limit. I think that Vegas has a limit. And I think that the debt really has to be paid attention to. So if you can figure out the debt equation in the gambling industry, because they've really levered up again, you'll have your answer. If I had to guess, if we do get a severe recession instead of a minor one, then gambling has got some issues. We'll see. It's incredibly high margin business, right? So we'll see. Again, I think this is a harder trade Could this just be the long-term trend line? If it is, then for dividend investors, this is fantastic. But what if there's a huge slump in Las Vegas real estate? I don't think that's out of the question. So I'm debating on VG right now. This is the one that got beat up. I really like Digital Realty Trust because we know the cloud is going to grow a lot. We're just trying to figure out where's the price. Somewhere in the 80s or 90s, Shooter is saying. Exact Sciences, you know that I know this one well. Has it hit an inflection point? We'll see. I don't doubt Kevin Conroy, the CEO, on anything. I've been watching him for a decade, longer, 15 years almost, whenever he got hired, 2008, I think it was. Is this the inflection point or is there another leg down? I don't know. I mean, they're targeting becoming profitable, so that'd be nice. I mean, all this way, they weren't profitable. Think that through. This company went from $1.65, and it was lower than that because I bought these guys at $1.65. Went all the way up to the middle 100s. And I said that the high end for them was 200, but 100 was my initial target. So I sold out between 70 and 100. Is this the inflection point? I don't know. That's turning over, right? These are one of the technical things you watch. This needs to bend up, so this can bend up too. I don't know, right? These are moving averages. I think that you probably see another dip here. We'll see. I'd be surprised if it doesn't retest its low. But if you really know the company inside and out and you believe in it more than I do, then it could have a heck of a rally. But I think this will be one of the first ones that Kathy Wood sells if she gets blown up again. Home Depot, it's all right. Another stock that's just okay. Not a lot of growth, right? It's just going to kind of do all right. It's got a trade in it here and there. Dividends not too sexy. It's just okay. Emerging markets. We bottom ticked this one. It's been rallying. Shooter has a target towards 40 before it gets a pullback and then probably goes up again. These companies got crushed. Combination of the stronger dollar and the tighter Chinese policy on tech. This is maybe going to be one of the best ETFs in the world over the next decade. So you want to buy the dips. If we get another one down here into the 20s, my number has been 28. We'll see if it gets back here to the 28 range, which he does have marked, and you haven't bought this, you should buy it. This is going to be in the retirement income options. You need to be aggressively selling puts on this one if you're not in it. CRISPR, it's a gambling company. It's gotten a lot of competition though. So the reason I'm not in love with this company anymore, right? Like I liked it down here, is in this time frame, it's gotten a lot of competition. So unless you really know something about this technology and you really understand it, and you can say, hey, this is where the market has it wrong. It's trading stock. Shooter trades it, chases the crowd back and forth. But fundamentally, I can't say that it belongs up here anymore. That doesn't mean you can't trade it if you're a trader, right? If you are a gifted trader like Shooter, if you know technicals, if it's in your risk tolerance. I know people who trade who don't know anything about what they're doing. They're just like, oh, my first trade was good, so I must be good at this. If you don't understand what's on this chart and what I put into my quantitative charts with the money flows, don't try to compete with the hedge funds and the supercomputers and the professionals. Ken Griffin's company Citadel made $16 billion last year. So clearly he's the one with the edge, not you. Boeing. I like Boeing going forward. I do. I like their technology. I like that they've taken their lumps. I don't know what price I like them from. If they get a dive down in here again, definitely have to look at it, right? If it retests down in this area again, right? It had a double bottom. If it gets into right in here, right? He has the primary wave set up at 120. I imagine this comes up. And that this 143 is probably more likely. We'll see. And the reason I say that is because the technicals, again, are looking backwards. If you can look forward and decide, okay, is it more likely to get positive surprises or negative surprises, right? Go back to your fundamentals and understand the secular trends that it operates within. Fourth Industrial Revolution, people traveling more because we don't have to work as much. Younger people deciding that working 70 hours a week is just not for them, that they want 4, 5, 6 weeks off every single year and Fridays whenever they feel like it. And technology is allowing that to happen, and they all know it's allowing it to happen. Travel, right? There'll be a lot of it. They have to build a lot of new, less, lower pollution airplanes. The new engines cut the carbon emissions in half. They got to build a lot of them because they're not out there yet. The entire global air fleet is going to be replaced over the next 20 years and grown. So I think Boeing's got a good future. So you want to buy the pullbacks here if you're looking for a dividend stock. Biotech, again, we talked about this in the last several months, setting up for a rally. That's that. So these charts are all in Shooter's weekly article over at Fundamental Trends. And I use them, right? I use them in real time. I don't just throw them all up at margin of safety, but when it's relevant to us on the longer term side, right? Because margin of safety is about position trading, long-term trades. Shooter's looking at more intermediate stuff. All right. Okay, let's call it a day. That went too long. I didn't even talk about this. I kind of talked about it when I was in here. I will get the stocks of the week up as we get further into earnings. And there's a couple of option trades that I think you want to make if you're retirement income options. I really like selling the puts on EMQQ because either you just make really good money or it gets put to you and then you make really good money. I think it's one of those really nice win-win things. All right, take care.